What if it's...
This is the Resilient Advisor Show with Jay Coulter.
Thanks for tuning in to this episode of the Resilient Advisor. This show is sponsored by Magnifi. Rethink the way you invest for the future. Visit magnifi.com and discover a new way to build and manage your models. Joining me for this show is Gary Kaminsky, who really needs no introduction to my audience. But in case you did not know, he spent 30 years as a guest host on CNBC, where he also had his own show called Strategy Session and was one of the founding members of Squawk Box. Today, he's a strategic advisor to a fintech company called Tiffin. Now, on this show, we're going to talk about what's happening in the markets. Gary's going to share some of his insights, as well as those of other industry leaders like Kyle Bass, Jeff Gundlach, and Anthony Scaramucci. And we're able to bring this to you because, Gary, it was a big week at Tiffin. One of your holding companies, Magnifi, they launched a new initiative called Magnifi Media. What do folks need to know about Magnifi Media?
Well, first of all, Jay, it's great to see you again. And I was actually just thinking, you said, if we get some questions that are appropriate, we'll answer them. Well, we can answer the inappropriate questions too. That's it, because it's a Friday and it's been an exhausting week for everybody. So we'll take all the questions. Anyhow, let's be very simple. You know, Magnifi has been called the Google of the investment product world. When I first met the company, literally 2 years ago, maybe 1 week into the pandemic, I was told by the former CEO of a very large financial institution, hey, you got to check this out. I've never seen anything like it. If you go to Google and you type in, I want to own a leveraged oil ETF, you're not going to get anything. But the brains behind Magnifi had written, and I'm not a technology guy, I'm not a programmer, I don't write code, but I understand that if you type into the Magnifi search bar anything using natural language search, you're going to get relevant listing of investment products. Much like if you go into Amazon and you say, I want to buy toothpaste, you will get a search, an unbiased, non-opinionated search of the best investment products that fit the criteria based on a very different criteria. It can be based on fees. It can be based on risk reward, volatility, long-term performance. And if you remember many, many years ago, for the viewers out there in the audience, there was a company, Remington Razor, and Victor Kiam, one-time owner of the New England Patriots. He said, I like the product so much, I bought the company. In this case, I liked the product so much, I became an investor in the company and a user of the product, and now helping them broaden out the product. Magnifi Media, quickly, was the brainchild of our leader, Vinay Nair, which was, let's create some content, the kind of long-form content that doesn't exist on CNBC or Fox Business, or even Bloomberg for that matter, where we can talk to really great thought leaders in the industry without commercial interruption, without having to talk about the stock of the day or the blow up of the day, and really just more of the kind of discussion that I like to listen to. What are you thinking about? How are you thinking about your portfolios? And helping us then utilize Magnifi to see how we as professional investment advisors, our audience, can strategically fit this type of thinking into their clients' portfolios.
Yeah, and the first three shows were blockbusters in terms of the guests that you were able to have on Magnifi Media. For viewers and podcast listeners, if you head over to magnifi.com/media, you can watch all of these interviews in full length, but we're going to play you some clips and talk about some of these hot topic items for financial advisors today. So, Gary, the first thing I'm going to do is play a short clip from Kyle Bass.
You haven't even begun to see the highs in crude oil. And I honestly don't know what a positive outcome is for Putin's moves here. I know what the dream outcome is that he picks up his things and goes home.
Now, that's Kyle's opinion. Let's bring in Jeffrey Gundlach.
Where do you think oil tops out?
I'm going to say $200 a barrel.
Really?
Yeah.
This year?
yeah, I think it's going to get there. Well, you got to remember, it's up 35% in a week, so it's on a tear.
Gary, I mean, those are big procrastinations. What is your take on oil and then their opinion of it?
Well, there was some consistency in the sense that really all of the guests that joined us felt that the move in oil was not simply just caused by the conflict in the Ukraine. So the consistency here is that the price of oil the movement has been pulled forward in some respects, given the long-term dynamics. I mean, Kyle, if you watch the entire episode, you know Kyle will explain how nobody disputes the fact that some of the green initiatives that are out there over the long term are going to change the dynamics of supply demand. But these type of transitions historically don't take 5 or 10 years. They take closer to 40 years. And so while demand around the world has really not changed, in fact, it continues to grow both with economic growth globally and population growth, the supply constraints really become the primary factor. Thankfully, I don't have to predict the price of oil. I let those that are smarter than me predict it. But what I think my takeaway, Jay, listening to the segments this week, was that energy was significantly underweighted going into this year by most active managers, and the reasons why were because of the political concern of the Biden administration trying to, in some respect, penalize traditional oil and gas companies. Then again, S&P technology had such a huge outperformance last year. Energy was an underperformance, and so you always have that closet index relative performance game. So you were positioned, you were in a perfect storm, so to speak, for what happened. The Ukraine just exposed what was inevitable, which was demand is still there, supply was shrinking, and now, again, with not a political comment, active money managers who were historically underweight the sector are now playing massive catch-up. And so the things that I take away are that the demographic changes that are affecting the price of the commodity, that's not going to change. Who knows what's going to happen in Ukraine in the next 2 weeks? Hopefully, it's somewhat of I don't want to call it a peaceful resolution because it can't be at this point. But if the commodity price goes down, I wouldn't be surprised to see the energy stocks decouple from the price of the commodity, because those that have been significantly underweight the sector, as Jeffrey and I had discussed, will be playing catch up now for some time.
Yeah, Gary, I've heard legendary trader Mark Fisher talk about that dynamic in the oil markets even before of all this. And I want to play a clip of something that you actually referenced when Kyle was talking about this type of change.
Historically, when we moved to coal and then we moved to natural gas and moved to crude, those energy transitions have taken 40 to 50 years. Think about this. We've been all in as let's just say the West has been all in on alternative energy, on wind and solar for the last, I think, 10 to 12 years.
I mean, we're just getting started with that theme. And boy, those chickens really came home to roost right now, Gary. And to your point, active management matters. What do you think is going to happen to a lot of these closet indexed portfolios through the rest of the cycle?
Well, it's funny. As we sit here on a Friday, an exhausting week, as I said, especially if you're a professional investment advisor, you've probably spent 80% of your time talking to clients this week, reassessing long-term strategies, and that's what the business, as we all know, is about. What I think is that if you are an active manager, and much like, the last couple of years, it was hard if you didn't own some of the, say, let's call it top 10 stocks in the S&P 500, and you weren't at least at the market weighting, you had relative underperformance, but clients understood that because, the markets were buoyant. This is the type of period, Jay, you remember when you and I, back in our Newberger days, would be out on the road, and we would say many times regarding the old cap core strategy, this is the time where active management, if your active management strategy, let's call it from January 2022, and let's take it out to July 1st of this year, those in that 6-month period, if you can't show that you can add significant relative performance over the S&P 500, and that doesn't mean necessarily just losing more than the S&P 500, then your strategy, in my opinion, is flawed. Because this is the time where opportunistic active management has to outperform a passive index. It's one thing when everything is going up. It's another thing when the indices are down, and you've got to show the outperformance. And so deciding, again, let's just take it back to the energy sector, deciding that you're going to underweight or in some cases not even participate in part of the S&P 500, you're making that active bet. Your clients have to see now whether or not that made sense. If you're an advisor and you're allocating to these active funds, you'll have to reassess, I think, come this summer, whether these make long-term strategic allocations in your clients' portfolios.
So let's pivot to inflation. I got to tell you, one of the things I enjoyed about all the content that Magnifi Media put out is your guests were not afraid to share an opinion that went against the grain. Here's Anthony Scaramucci on inflation.
Let's talk about inflation. Goldman Sachs came out with a note earlier saying that they think inflation is going to be even worse than feared, which is kind of amazing because I'm already pretty afraid of inflation. What is your take?
I had the opposite take. I could be totally wrong. Obviously, I'm more in line with where the central bank is. I think that there are tremendous transitory issues. I don't think inflation is going back below 2% anytime soon, but I think we've got probably one more quarter of nasty inflation numbers. But as the supply chain resets itself and the U.S. economy in particular, the global economy en masse, but the U.S. economy in particular starts to normalize, you'll see those inflation numbers come down.
Let's talk about.
What's your take on Anthony's position with inflation?
Well, the mooch is never shy of giving opinions, that's for sure. My personal take in terms of, well, let's just step back for 1 second. Why is it important to focus on inflation when you're acting as a fiduciary on behalf of clients? When clients entrust their capital to you, there's almost always a twofold or two-pronged approach. You want to grow those assets ahead of inflation so that the assets are meaningfully able to grow in excess of whatever the inflation rate is. And then obviously, depending on the specific allocation, whether it's preservation, whether it's income, but inflation and how you decide to manage in terms of inflation expectations is, if not the most important, the second most important thing you have to think about. So my personal feeling, and again, I guess I'll go out on a limb here, is that if we had not entered this geopolitical issue with Russia, Ukraine, I felt, and I'm certainly not speaking on behalf of the Fed here, that later this year, that we were not going to be talking about inflation in the economy as much as we have the last 6 months, primarily because I think a tremendous amount of inventory buildup that was going to take place once the component shortages in Asia got sorted out, people got back to work. One thing about this week, Jay, I think you would agree, is that I think it was the first week in 2 years we really heard nothing about COVID, if at all, other than the airlines, deciding that for whatever reason, you can wear, you don't have to wear a mask anywhere, but you have to wear a mask on planes for the next month, which that's another story for another day. But I think that that inventories were going to be built across many manufacturing industries, and that a lot of the demand got pulled forward. And so the question was, once the inventories were rebuilt later this year, what we actually going to have, and Anthony and I had spoken about this off camera at some point, more of a potential deflationary environment as inventories were built and demand got pulled forward. I'll give you a perfect example. I had to replace a refrigerator a couple of months ago, 20-year-old refrigerator in a house. To actually replace that refrigerator, you had to pay 25% above, let's call it list price. But it's a refrigerator, you have to do it, so you buy it. That demand got pulled forward. All the people that were complaining about buying used cars, but they paid, significantly above Blue Book value, they bought the used cars because they needed them. They pulled that demand forward. So my feeling was that inflation was probably, I'm not going to use the word transitory, but was probably in a declining state later this year. Now with the spike of oil and the feeling that we're going to have this commodity food inflation until things get resolved, that might change the timetable here. But once this gets sorted out, I do think that longer term inflation, and the Fed will probably be happy that I'm going to say this, that longer term inflation will get back to the more normal levels that it was running at, because the deflationary conditions that have existed, let's call it for the last 20 years, more manufacturing production out of Asia, Mexico, that's not going away. That's going to continue.
Well, you and Jeff Gundlach must have circled up your notes on that one. Let me play you a clip from his interview on Magnifi Media.
So as weird as it sounds, I actually like cash in the bond market, short-term maturities. And I also think you're supposed to own some of, let's just say, TLT, the ETF, that can go under a certain way that this movie runs. It can go back down to 1%, which could give you some portfolio protection.
So, right, his thinking seems to be in line with yours over the intermediate to longer term.
Yeah, I mean, I think Jeffrey has a more. First of all, Jeffrey has made some very bold predictions over the years, and it's funny, people like to pinpoint, okay, some of the things that he's gotten dramatically wrong. He made one bad call that's been pointed out many times when he tried to speculate on Apple stock. That's not his forte. How about the fact that Jeffrey Gundlach, when he joined Scaramucci and myself on Wall Street Week in, I think it was sort of it was late 2015. I'm not even sure if Donald Trump had officially announced he was going to enter the race. Gundlach, as far as I know, was the first person to ever predict Trump would seek the nomination and actually win the presidency. So he does make bold predictions, much like the $200 oil prediction, and his track record speaks for itself. I think he's a little bit more convinced than I am that we're in a stagflation environment right now. I think it's highly probable, but I don't think we're there yet. I think the economy is still growing, and will continue to still grow, but we'll see. I mean, he's definitely more of the opinion that we're in this stagflation environment as we sit here today.
Well, if let's pivot to stagflation, and we're going to have to talk about the Fed. I want to play you a clip from Kevin Simpson's interview on Magnifi Media and his thoughts.
It is an incredible thing to think about. I've been in this business for 30 years, and we're literally talking about the textbook stagflation, and it's an odd combination, a contracting economy with rising rates. And can they do it successfully? Can they navigate us through that is a tremendous question. But to say that they have no choice isn't even up for debate. I mean, we have to begin to taper this inflationary pressure. And the only way for the Fed to do that is to begin raising rates.
So before I get your comments on that, Gary, I want to play a clip from Jeffrey Gundlach sharing his thoughts on the Fed moves throughout the rest of the year.
I know that 50 basis points seems like it's off the table here in March 2022, but I think a 25 is just a guarantee. And I think there's going to be at least 4 hikes. So that's what's coming. The inflation rate is so high compared to the interest rates that it's going to take some real action, I think.
For financial advisors managing real money for real people, especially those in retirement, what do you do, Gary?
Thankfully, I'm not in that seat right now, Jay, because I got to tell you, it's difficult. We're in a very stressful environment. And what I would say is, what I've been thinking about this week is, as the Fed has telegraphed, more or less the 100% certainty of the 25 basis point move up in the Fed funds rate next week. I've been thinking, what if the Fed, and it sort of took me back, I think it was early 90s when there was a it was an intermediate, it was between meeting move when the Fed had raised rates at one point, and the initial reaction was that the stock market would take it very negative. In fact, the stock market took it positive. So I was thinking that in light of everything that's happening with Ukraine and the mandate of the Fed, obviously price stability and full employment, what would happen to equity markets if in fact the Fed moved 50 basis points and decided that they wanted to send a message to the markets, regardless of the short-term impact? Would that be perceived as a positive longer-term outlook? And so I'm not on the Fed. I'm not making a Fed policy. But it's something that I would think about because the market's already down and the market wants to the long-term investors want the stock market to feel comfortable that the Fed is paying attention to what is happening with prices right now and that should be the primary focus. Now, the difference between Jeffrey Gundlach and Anthony Scaramucci from the Magnifi sessions this week, Anthony feels that the Fed is going to move 3, maybe 4 times to get the Fed funds rate up to 1% or just up to 1%. And at that point, they'll be so concerned about the recession that we may or may not be in at that point that they're going to back off. Jeffrey thinks they will continue to raise rates, maybe even over 2%. And the biggest takeaway that I had from the session, from the interview this week, was the feeling that once we get to those levels and we're in a recession, that the Fed is going to go once again to the strategy of not just cutting rates, but find another way to implement QE. And so QE, which obviously started after the financial crisis, which has been a staple of the central banks now for, I guess, 13 years, Gundlach was with almost certainty that there's going to be QE 7, 8, 9, which then gets us into the whole idea of managing your client's assets. You've got to think about all of this money printing. If he's correct, it's going to take place for the next decades as we go through these cycles up and down in the economy. I can't make a prediction on interest rates, but I will tell you, if I was a voting member of the Fed, I would seriously consider, given the market conditions, of making a 50 basis point move right out of the gate.
Yep, to make a statement. And I've heard several other folks voice that same opinion. I've also heard a lot of folks voice their opinion on Bitcoin and cryptocurrency. There was news out this week from the Biden administration and some rules and regulations that they want to start implementing. But one segment that you guys had on Bitcoin I thought was really interesting. And I'm going to play you a clip from Tim Seymour.
If you are a modest investor or you're someone who's pitching to a modest investor, in 1 minute, how do you explain the value of investing in Bitcoin? Why must you do it? Tim, you go first.
Well, I'll just point out that part of the rationale and the raison d'etre for Bitcoin is ineffectual central banks around the world. So whether an outright inflation hedge or, again, think of the unfortunate global scenarios that scenario that's playing out in Russia, Ukraine, and think about the fact that probably appropriately the US, the UK, and the EU said they're going to freeze $300 billion of central bank reserves for Russia. Look, that's what should happen in what's going on with this crisis. I get that. But if I'm another country around the world, then I see the autocracy, the ability of the reserve currency central bank of the United States or the EU or the Bank of England. Look, that concerns me. So I think this is as much, and by the way, that's all very dollar negative in the longer term. And, we can get into macro and how we're going to finance the US deficit. But I think this is all an argument for Bitcoin. And okay. I think it's all an argument for why the investment thesis here continues on.
So Meltem, it's basically that central banks and governments around the world are run by propeller heads, as Anthony Scaramucci would say. What's your 1 minute argument?
Yeah, it's actually 10 seconds. Bitcoin is an antidote to chaos and institutional incompetence that you can own in your portfolio. That's it.
Isn't she great? That was the most popular clip we had on social media because Meltem got right to it. Gary, you and I have never had a conversation about Bitcoin. What is your take on it? And then as Tim was trying to articulate, how do you make the case to a moderate investor for the asset?
Well, first of all, let me just say that Tim is a better dresser than I am, and he's definitely got a better background, in his shot, that's for sure. Like many in the audience, I'm sure they've struggled to figure out, should they have a asset allocation to Bitcoin, crypto, or should they not? Again, one of the things that I'm happy that I'm not actively managing money right now is because that's a tough decision. I've tried to understand, Jay, that when we ran the portfolio at Neuberger, one of our sayings, the founding member of the team, Joe Lasser, was, we're never going to say we're not interested in something. If we don't know about it, we're going to try to learn. The thing is that I understand, I absolutely understand the case that we need to have some sort of storage of value, some kind of currency equivalent, not just gold, that's not linked to central banks. We just talked about what's happening with the Fed, what's going to happen with the European Central Bank. And so there's no disputing that. But whether it's in a private crypto or in a government-controlled crypto, I leave that to people that follow this much more closely than I do, what's going to be the ultimate outcome. I've read just as many pieces as those in the audience have, that this is a Ponzi scheme and it's going to zero. And then Anthony did an excellent job explaining why he decided to pivot some of the assets at Skybridge into crypto, use the analogy of Amazon over the 20 some odd years. If you've actually stayed in Amazon through the massive move earlier this week with the split and the buyback, you've had drawdowns as much as, at one point, I think he said 90%. And there's not many long-term investors who sat through something like that. So that's a long way of answering the question. I don't really know, Jay. I really don't know what's going to be the long-term outlook for crypto or Bitcoin, but I do feel that the nice thing about Magnifi as it relates to trying to figure out how to have some of an asset allocation into this asset class, if you deem it's almost like, in some respect, buying insurance, because in fact you might want to look at this as a different asset class. You can go into the Magnifi search bar, as we did on the program, and you can find ETFs where you're not actually owning the asset, but you're owning variable plays on it from either exchanges or some of the ETFs that hold some of the other crypto coins. And so there are ways to, 30 years ago, you couldn't do that. 30 years ago, you'd have to make a decision. I want to be in this or I don't want to be in it. There are soft ways around it, utilizing managed accounts and mutual funds and ETF products. And so as a professional managing money, working with your clients, understanding that in some respect, it might even be like buying an insurance policy. When you buy auto insurance, you spend money and you hope that you hope at the end of the year that thankfully you're not in an automobile accident, you haven't had to repair your car, and that money is gone. So I would think of crypto as an asset manager in the same kind of way, at least right now.
Yeah, Gary, we've done a lot of work on Financial Advisor TV in the crypto space. I'm never the expert. I bring them on, we interview, we break it down. And two of the better ideas I've heard from it are Matt Hogan, who is with Bitwise. He said, really, it's an alternative asset class. Don't make it anything more than what it is, and size the risk appropriately. And then Michael Venuto, who's the co-portfolio manager of the ETF Block, BLOK, in the blockchain space. He said, this is the pets.com era of the blockchain. So you have to pay attention into what you've talked about this whole program. Active management matters. And that's true in the crypto space as well.
Yep.
So Gary, I want to wrap up with a hot topic, and I saved this for last, and that's all the geopolitical risk that we see in the marketplace. And I tell you, that Kyle Bass interview was fantastic. Podcast listeners, please head over to magnifi.com/media and listen to the Kyle Bass interview. But Gary, I want to play you 2 clips on his take on what's going on.
If you go back to the February 4th joint communique, joint press release between Xi and Putin, it goes to show you that this was premeditated. And what I mean by that is, in this communique, Russia, or let's say China, gives Russia the go-ahead to talk about one Russia and the reunification of the Ukraine.
And then he went on to say,
what we're witnessing here, I believe, is the bifurcation of the world into 2 world orders. One is the rules-based West, who prioritizes human rights and climate and everything that you and I have near and dear to our hearts. And then you have the axis of evil.
The bifurcation of the world. I mean, if you're a financial advisor and you're managing money and that's your thought process, how do you go about adjusting portfolios? What worldview do you need to have when you're managing money, processing this type of thought process?
Well, again, let's just also take the other side of this for a second. You also have to be aware of the fact, I was just reading something before we went on live, that some military strategic thinkers, I read some of these think tank pieces, said that this Ukraine, the Ukraine situation, let's call it that, may resolve itself in the next 7 to 10 days without any kind of predictions of what the outcome will be. You have to remember that markets are always looking so far in advance, and if it resolves, and the price of the price of oil, which seems to be what the equity markets are most tethered to right now, starts to see some decline. If you are an asset manager and you've decided, okay, I need to sit this thing out, and you raise a tremendous amount of cash, Jay, I think you might remember. I think it's if you're out like if you go back historically and you look at the 10 best days in the S&P 500 over a 52-week period. If you're out of the market on 6 of those 10 days, the likelihood is something like 95% of significant 5-year underperformance because of the way compounding works. So you're making a big bet if you're trying to time the market. Doesn't work. I mean, it works for 5% of the people. It's probably more like 2% of the people. So you can't time the market. You have to be aware of these things. What I will say is that the news overnight seemed to be that China was deciding kind of under the radar to try to tell the Russians that we've seen enough, we've had enough, and it's time to, figure some sort of resolution, which is what Kyle was more or less predicting on Monday, was that the end of this conflict really runs through Beijing much more than it does through Europe, Ukraine, or Russia. So let's see if he's right about that. He obviously has extremely strong opinions about the sanctions, and that many of the sanctions are not working because they're bypassing it through China. But from what I've seen this week, and as we wrap up the week, clearly the Russian economy has been crushed. The stock market, when it reopens, crushed, asset prices. And so in some respects, sanctions are working. But my advice to the investment advisors, if I was working with you and working with your clients, is you can't construct a long-term asset allocation portfolio today having any kind of objective in your mind as to what this conflict will be. There'll be something else a year from today that's going to have a short-term impact. Remember, 16 days ago, this was really not the focus. The focus 16 days ago for those actively managing money was, how are we going to navigate a rising interest rate environment at a time where growth was slowing down, which is really something that we haven't seen. We haven't seen the Fed raising rates aggressively into a economy that was also slowing down. And so that will be, after this conflict is resolved, that'll be the focus. And so we played around with Magnifi a bunch of times this week trying to figure out portfolios that benefit from inflation higher than expected. We played around with a number of things in the search bar trying to figure out if there are ETFs that might be more leveraged to stagflation. It's those type of allocations that one has to think about, because we both know, Jay, that every week is always a surprise in this business, and next week will be no different.
Gary, it's been a real treat having you on Financial Advisor TV. Financial advisors, try and up your research game. Go check out magnifi.com and look at the incredible research platform they have for financial advisors. So this show is part of the Financial Advisor TV network. Replays can be found at financialadvisor.tv and all the social media platforms. Gary, thanks for coming on.
Yep. Thanks, Jay. Everybody have a good weekend. Get some rest and be safe.